All right, so our second review test, number one, which of the following would be included in net income? It would be a gain from disposal of equipment that occurred on the last day of the accounting period. A, C, and D all have to do with unrealized gains or losses. And so anything that is unrealized does not go into net income. It may go into other comprehensive income, but not into net income. Which of the following income statement items is considered to be permanent? Now, what we need by permanent is not the same thing as permanent accounts in our journal of accounts or trial balance. What we're talking about permanent is when we're talking about quality of earnings here. And so the interest expense would probably tend to be permanent on that. Number three, which of the following income statement elements is an economic inflow that occurs primarily from operations? That would be a revenue. All right. Number four, which section of the multi-step income statement reports revenues and expenses related to secondary operations of the entity? That would be the non-operating section. There is a non-controlling interest. This is equity, so we don't really have that yet. But the answer is going to be when the company uses the equity method to account for ownership is the answer in that. Number six, which of the following is not a limitation of the balance sheet? Many balance sheet accounts are reported at historical cost instead of market values or liquidation values. It is that one. Which of the following is a current asset? And that would be the treasury bill acquired with 2 months to maturity. Number eight, which of the following is not a current liability? A bond sinking fund. A bond sinking fund is actually an asset. Which of the following is not a component of shareholders' equity? Accrued liabilities. Hendrickson Corporation's trial balance for July 31, the end of the fiscal year, included the following accounts. Investments are treasury bills that were purchased in May and mature on August 15th. Prepaid insurance is a 3-year policy that was purchased on July 31st. The amount that should be classified as current assets in the July 31 balance sheets is, okay, so the accounts receivable is, the inventories are, the copyright is not, the investments are treasury bills purchased in May, June, so that one would be. The prepaid insurance, that would be 2,000. So one third of that, since it's a 3-year policy. The note receivable due in 2 years is not, and the cash in bank is. So we've got 4,500 plus 2,000 is 6,500. 47,500. 58,500. 115,500. So let's see. Did that wrong? Yeah, I did. I added up, and it should be 125,500. B. All right. Glover Corporation's trial balance, December 31st, the end of the fiscal year, includes the following accounts. The amount that should be classified as current liability. So we've got the accounts payable. Dividends payable is a current liability. Bond payable in 9 years is not. Salaries payable is. Note payable in 1 year is. Note payable in 5 years is not. So 30, 70, 79, 101. Number 12. Which of the following is classified as an operating activity on the statement of cash flows? Payment of dividends is not. Sale of equipment is not. Issuance of common stock. Purchase of inventory with cash is. 13. Which of the following is classified as a financing activity on the statement of cash flows? Redemption of a sinking fund would be payment. Redemption, no, that's not right. Payment of the sinking fund. So payment of dividends, that one is. Let's see. Number 14, when preparing the operating section of the statement of cash flows using the direct method, which of the following statements is true? An increase in accounts payable is subtracted from cost of goods sold. Yeah, an increase in accounts receivable is added to sales. No. Depreciation expense is added to cash flows. Now, when we use the direct method, we don't do anything with depreciation. And gains from long-term assets are subtracted from cash flows. Again, we don't do anything with gains on the direct method. So the correct answer is an increase in accounts payable is subtracted from cost of goods sold. Number 15, Danielson had salaries payable of $70,000 on January 1st and $30,000 on December 31st. During the year, Danielson showed $550,000 in salaries expense on the income statement. Cash flow for salaries were, well, we would subtract 30,000 from 70,000, so that would be 40,000. So we paid 40,000 more than the salaries expense, so that would be 590,000. The timing of revenue recognition is dependent upon the control of the good being in the hands of the buyer. Okay. Number 17, when a contract is expected to affect the risk, timing, or amount of an entity's future cash flows, the contract is said to have commercial substance. Number 18. In determining whether the promise to deliver goods and services is separate from other promises, an accountant must often rely on professional judgment. Number 19, Walker Consulting helped McCall roofers put various cost savings techniques into place. The contract specifies that Walker will receive a flat fee of $70,000 and an additional $17,000 if McCall attains a target amount of cost savings. Walker estimates a 20% chance McCall will reach the target for cost savings, assuming that Walker uses the expected value approach. What is the transaction price for this product? So we take the 70,000 plus 20% of 17,000, which would be 3,400, be 73,400. An example of a good transferred over time would be a magazine subscription. All right, so on to the problems. For this one, Truco Inc. provided the following partial trial balance for the current year. Prepare a multi-step income statement for the year ending December 31st. Truco is subject to a 40% income tax rate. Okay, so first thing we always have is the revenue. Sales. Here we go. So sales is 225,400. Dividends are never on the income statement. We then have cost of goods sold at 90,100. So that's 135,530, and that is our gross profit. On that, we then look for our operating expenses. Okay, dividend income is not operating expenses. Interest income is not operating expenses. Gain on disposal of plant assets is not. Unrealized gain on trading investments is not. Office supplies is. $4,500. Salaries expenses. Sales salaries. 8390. Selling expenses are $11,210. Accounting and legal fees, $2,400. Advertising expenses, $6,600. Depreciation expenses, missed the office salaries expense, the administrative expenses, general administrative. $480. Interest expenses, $1,840. Oops, interest expense was $2,570. Okay, the loss on asset impairment is that's like a depreciation factor. Gain on disposal of plant assets is. Okay, so this is going to be our total operating expenses. Add that up. 500 plus 8390 plus 11 2400 6660. And that'll be 100,650. I need to go up here because I forgot to add the gain on disposal of plant assets. And that was 14,810. And so my operating income is $49,460. And we're going to have our other income and losses. So we'll have the dividend income, 3830. We'll have the interest income, 1450. Unrealized gain on trading is going to be other comprehensive income. Everything else we've got. Okay, so we have a total of 3830. Answer 1450 plus 5,280. Earnings before tax is 54,740. We have a tax rate of 40%. Income tax expense is 21,896. $54,740. End up with net income of 32,844. Now we would also have the other comprehensive income would be the unrealized gain on trading securities. Not seeing all that. Would be the 7,270. So that would give us 40,114 as comprehensive income. All right. So that's number 21. And here we have classify the following accounts as assets, liabilities, or shareholders' equity, and whether they are current, non-current, or not applicable. Okay, accounts receivable are asset, accounts payable are liabilities, supplies are asset. Those are all current. Bonds payable due in 10 years is a liability. That is non-current. Investment in company A to be sold in 6 months. That is an asset and it is current. A copyright is an asset and it is non-current. Additional paid in capital is a shareholder's equity and that is not applicable. Retained earnings is a shareholder's equity and that is not applicable. Land is an asset and that is not current. And wages payable is a liability and that is current. Notice how anything with a stockholder's equity is not applicable to current or not current. Number 23. Compute the cash flows from operating activities for Falcon Corporation under the indirect reporting format. Falcon Company provide you with the following information for the current year. Accounts payable relate to selling, general, and administrative expenses. Okay, so we start with using the indirect method. We start with net income, and that is going to be 138,360. Okay, we add back depreciation expense. 48,000. We take out the gain on the sale of equipment. That's an investing. Activity. Other expenses, income before taxes, tax expense, net. Okay. So cash, we don't worry about. That's what we're trying to reconcile to. Accounts receivable in 17 was 42,000. 142,300 and 124. So we have a decrease in accounts receivable. So a decrease in accounts receivable would be an increase of 17,500. The investment's non-current. We have an increase. Let's see this. So that's not going to be the operating section, so that doesn't apply. Prepaid rent went from 268, so that's an increase of 268,300, and it went up to 293. Whoops, I was wrong. 268,300, and it went up to 293,800. So that's an increase of an asset, so that's a decrease of 25,500. Accounts payable, 123,400 to 149. So that's a liability. Increase in liability is an increase in cash flow. And that will be 25,600. Income taxes payable, that's an increase. So that's 8,300. Increase in the liability. 1,600. Let's see. This is accounts payable. This is income tax payable. Long-term debt is a financing, and common stock is a financing, so it does not apply. And so we have 138,360 plus 48,000 minus 3,500 plus 17,500 minus 25,500 plus 25,600 plus 1,600. And so we get an increase of cash of 202,060. Okay, so that would be cash from operating activities. Okay, number 24. We just did this on the last one. Don't need to do that again. Okay, so this is one like we did earlier today. Craft Construction entered into a contract to construct a generator station for a utility customer. The contract calls for the customer to pay Craft Construction $900,000. The project was started in 2019 and completed in 2020. Cost and other information is completed below. And they're going to use the percentage of completion method. What is the amount of profit to recognize each year? So cost incurred during the year. So 2019, we have 225,000. And we divide that by 225 plus 450. We multiply that by 900,000. So we get the 225 divided by 675. 33%. 900,000 would be 300,000. That's our revenue minus our costs incurred during the year 225. And so that would be 75,000 profit in 2019. In 2020, we're going to have the whole 900,000 minus the 300,000 that we've already recognized is 600,000 minus our cost incurred during the year was 550,000. And so our profit in 2020 was 50,000. All right. So that completes that test. Got one more to go here.